The feds keep increasing rates. You hear a ton of noise on the media about falling housing prices. We've got a ton of buyers just on the sideline who don't know what to do. They want to see what happens with housing prices or interest rates, and they just put their house hunting on hold. We're also hearing the media say that there's going to be a wave of foreclosures happening. So how do you decide when it's a good time to buy or sell a home in today's market? Well, in this video, I'm going to share with you some data that I have. I follow a very well-known guy named Barry Habib with MBS Highway, and he shares a lot of wealth and knowledge about inflation, mortgage, how the recession impacts housing. And this video just kind of summarizes the data that he provides so that it can help you make a decision as to whether now is a good time to buy for you and your family, or if you guys want to make a move in that real estate market. If you're new to our channel, make sure to give a little love to that subscribe button and click on that notification button so you can be the first to know about what's happening in our Northern California real estate market. Hey, I'm Rose Gonzalez with the Gonzalez Real Estate Team, and I hope you find a lot of value from this video. And if you have any questions about the real estate market, or if you are getting ready to make that move to Northern California, make sure to give us a call, shoot us a text, or send us an email, and we'd be happy to help guide you in any way that we can. So let's go ahead and get started with the video. So what's happening in the marketplace is probably something you're wondering right now. So what we're seeing is housing is impacted by higher mortgage rates. So things are sitting on the market a little bit longer. Buyers are on the sidelines. They're not jumping on the opportunity to buy a home right now. They're trying to see what's going to happen with prices and interest rates. And we have also had buyers fall out of the market because they can no longer afford a home because of interest rate increases. And also inventory is still tight. And we'll talk about that a little bit later. But the question is, what drives mortgage rates? So the driving factor of mortgage rates is inflation. And I know a lot of people hear that the feds are increasing rates and mortgage rates are going to go up. And yes, while that has happened, mortgage rates have gone up because of inflation and not necessarily because the Fed's increased rate. So the Fed rate going up is actually going to help mortgage rates in the future, and we'll talk about why that is later. So let's talk about how inflation drives mortgage rates. Here's a good analogy that I've heard. Let's say that I'm letting you borrow $500,000 and you're paying me $2,500 a month on a 3% interest rate. Well, I can make a list of my groceries, my bills, all these things that I have to pay with that $2,500 a month payment that you're giving me. Well, now that inflation has gone up, all the prices for my services and things that I'm buying are going up as well. And as those numbers go up, I can no longer afford everything that I want on my list with the $2,500 a month that you're giving me for the money that I lent you. So the only thing left for me to do is increase my rates so that I can get a little bit more money from you so that I can continue to buy and pay for the services and the goods that I want. So rather than a $2,500 a month payment that I'm receiving from you, maybe that goes up to $2,800 a month, which helps me buy everything that I need because prices have gone up. So that's why inflation drives mortgage rates. Now, when the feds increase rates, it does not increase mortgage rates. It increases rates for like cards, credit cards, stuff like that. Now, when a family goes out and buys a car, let's say back then when the Fed rates were at 0%, you can go out and get a car and the interest rate for that would be at a really low rate of 3%. Let's say your payment for that car would have been $500. Well, now that the Fed rates have increased, now that 3% interest rate is now 5% interest rate. And now instead of a $500 car payment, you're looking at an $800 car payment. So that family who was going to buy a car for $500 a month would now revisit whether they want to buy this car or not because the payments went up $800. So then because it went up, that family decides not to buy that car because it's just more expensive now. So that is how the Fed rate increase impacts inflation. Inflation is the amount of money going into the marketplace when people are purchasing things. So now that rates are higher, it costs more for people to buy things, and therefore it slows the buying power down. So now let's look at inflation. So this is the core consumer price index, and this is the measurement that we use for inflation. So now let's look at inflation. So this is the core consumer price index, and this is the measurement that we use for inflation. If you take a look at adding November through September, like I said, it's 6.6% year over year. And if you take a look at the numbers from July, August, and September, you see how low these numbers are right here. They're in 0.3, 0.2, 0.3. So we know moving forward right now that these numbers are really low. So the numbers that are going to come out for 2022 right over here are going to be higher because we were seeing higher inflation and higher spending. So it doesn't take a lot to give higher numbers for these low numbers that we had in 2021. So if you take a look at August, September of 2022, the CPI went up to 0.6 from where they were in August, September. And so that's why we saw a big tick up in mortgage rates, because inflation was high. I don't have the update page for October, but for October, we were at 0.6 last year. And actually, the numbers just came out a couple days ago, and it was at 0.3. So it went back down to where the July numbers were. And so rates got a little bit better because the inflation number went from 6.6 in September to 6.3. So the new readings that are coming back will be lower because the feds have increased rates. So as the feds are increasing rates and people slow down on consuming and buying, the numbers that are going to come out in the next few months are going to be lower than these high numbers. The inflation readings are going to replace the higher inflation readings from last year, and the year over year is going to continue going down. So some experts that we've been following do believe that rates would go down to the 5% in the first half of 2023. Now, another part to the CPI is that 39% of the core CPI is shelter. And we all know that right now, housing is going down. So we are seeing a deceleration of housing prices, and shelter costs kind of have a delay, just like with the consumer price index, we have like a year over year. We are actually the same with the deceleration of home prices. So the feds are looking at home prices at the tail end. So as we come into January, the experts believe that we will see numbers slow down, and that the CPI numbers that include the shelter, which again is 39% of the CPI, is going to catch up with the data. So we anticipate inflation numbers, the CPI numbers, to kind of see a better number come January, which the January numbers will be out around February 10th. All right, so why is it a good time to buy right now? So right now, things have slowed down quite a bit. We're seeing buyers that are able to negotiate better prices. We're able to negotiate better terms. We have all of our contingency in place, and we have actually been able to ask for seller credits. So whereas the last couple years, you had to pay 50, 100. I mean, we've seen them even go up to 150,000 over asking price. It was ridiculous to have any contingencies in place on an offer. We basically, had to do no contingencies on all of our offers, and there was no way we would ever be able to get a seller credit approved. So right now we're seeing that in the market. We've had clients get up to like $10,000-$15,000 seller credits. All of our contingencies, our inspection, loan, and appraisals are all in place. And we've been able to get ranging from 30 to 40,000 below asking price, depending on how long the house has been on the market. Now, there are homes that are priced very well that are still selling in a good amount of time and maybe even getting a little bit over asking. But it's all in the strategy of how the home is being presented to the market. So rather than asking the seller to reduce their price, we have found that asking a seller for credits to do a buy down, a rate buy down, is actually more beneficial to the buyer in the long run because you're paying less on interest. Now, one of the things that you guys will be hearing right now is a 2-1 rate buy down. And what that is the first year, let's say interest rates are at 7%. The first year you get 2% off. So your interest rate that you're paying your mortgage on is 5%. So you are paying 5% on the first year and then 6% on the second year. And the difference in the introductory rate, which is the 5 and 6%, versus the current rate, which is the 7%, is paid up front, and you would use the seller credit to pay for that. And typically a 2-1 buy down, the cost of it is about 2.5%. So that would be a seller credit that you would ask for. Now, because of the numbers that we're looking at with inflation and the CPI, again, the experts are predicting that rates will get back into the 5% at some time next year. So you can actually get a 2-1 rate buy down, ask the sellers for credit, and refinance your home next year when rates go back into the 5%. Now, the cool thing about the 2-1 rate buy down is because it was prepaid and paid up front by the seller. So let's say you had 1 year at 5%, and your second year you refinance back into like the 5%. So you didn't use any of the second year prepaids. So then you get refunded the second year prepaid to pay for closing costs for your refinance. So with all that being said and done, you're probably wondering, well, I'll just buy a house when rates go down. Well, don't wait for rates to go down. Why is that? Because everybody else that's on the sideline is going to go out and buy that home. You want to buy a home before everybody else gets back in the market, because what that's going to do is, because we still have a lack of inventory, there's going to be more competition. All the buyers on the sidelines are going to go out and buy homes again. What that's going to do is it's going to increase home prices because, again, we're still lacking inventory. You're going to have multiple offers again. Not that we'll get into a point where the contingencies and all that stuff will go away, but you are still going to be competing with more buyers. So what we advise you to do is, if you can, purchase a home now where things are still a little bit slower. You can get the terms that you want, negotiate on the price, and possibly have a seller give you credit to buy down your rate, and then refinance next year when the rates go back down to the 5%, because you have more of an opportunity to find your dream home than when the market was really crazy and we're competing for houses. So if, people who bought homes in the last couple years had to have settled for a home, because if they even took 2 seconds to think about whether they like that home or not, that home would probably be gone by the time they made their decision. So right now you can buy your dream home, negotiate on prices, get a seller credit, and then refinance next year. So I know a lot of people have been talking about recession. There's just a lot of fear going into the market as far as recession goes. So I wanted to go over what a recession does and its impact on the housing market. Right now, everybody's saying unemployment's really low. There's no way we're in a recession. Recessions start when unemployment rates are low. And the reason why that is because, you know, when demand is strong, people hire more people. So, when the market's amazing, we hire more people so we can, give people more of our services. Well, when things start to slow down, we lay people off. So right now, you guys are seeing companies lay people off. So that brings our consumer spending down. Well, now that those people who are laid off are no longer working, they budget on things that they spend. So they don't go eat out as much. They don't go to the movies. They don't buy stuff like they used to. So all those other companies that they used to buy from are now seeing a slowdown in their area. So then what happens? Those people would then have to lay off people as well. And so then you start seeing the upward trend of unemployment when we're in a recession. So what does that do to mortgage rates? So as you guys know, in the last couple of years, the Feds decreased rates because they wanted to stimulate the economy during the pandemic, because people stopped spending. So during the pandemic, that was another recession, and so people stopped going out, people stopped spending. So the Feds dropped rates down to stimulate so that people would buy more stuff. Well, if you look at history on this chart right here, going back to 1972, mortgage rates have dropped in each recession. So right here, you're looking in the 2000s, it went from 3.75 to 2.75. Here, it went down from 6% to 4.875, 7.3 to 6.75, and so on. So what does that do to the housing market? And so we have had 9 recessions over a period of time, and housing continued to remain strong during a recession. So 8 out of the 9 recessions, home prices went up, except for this period right here. This was the 2006, 2007, 2008 recession. And the reason why this was the only exception that we had was because this recession was caused by housing. This was caused by the housing industry. And the reason why it was caused by that was because those were the times where lenders were lending to people, no income, no assets. They were giving out, negative amortizations, and people didn't really know what that was. If you had a credit score and a job, you can go buy a house of whatever price point, and you didn't really need to show proof of that. So a good amount of the people who bought homes in this time frame could not afford the homes that they were in, and the lending guidelines were so lenient that people were getting to these crazy programs and people were not qualified to buy their home. Now, if you look at lending practices today, you have to show proof of everything. People are well qualified to buy their homes. We don't have the stated income, stated asset type loans. We don't have the negative amortization loans. So the lending practices now are a lot stronger and stricter than they were back then. So let's talk about supply and demand, because that also played a very big part in the 2006 to 2008 housing market. So supply is when a builder completes a home. This doesn't include homes that are currently being built, like under construction, or resale homes. And the demand is when a household formation is formed. So an example of household formation is, let's say, when a mom, a dad, and a son become 2 households because the son becomes of age, he goes out and buys his own home. And on average, we're looking at 33 years of age. So back in 2006, 2007, if you take a look at the household formation, it dropped. So in 2006, the household formation dropped to 1 million. And then in 2007, it dropped to 500,000. People kind of wonder, well, why is this? So if you go back to 33 years, so let's say the average person who moves out of their home and creates a formation is 33 years. So you go back to 1973. So 33 years earlier, you see the birth generation went down. So, here you have the baby boomers, birth rates went up. Here, birth rates went down, and now they're back on an uptrend. So that's why you see that the housing formations dropped in those years. But right now, you can see the trend where the housing completions, which is the orange, is lower than the household growth. So starting in 2017, we are seeing more demand for the supply. Okay, so new housing supply is 1.4 million. There is a total of 1.3 million supply that the builders are building, and then household formation is at 1.7. Now, what I'm hearing is that builders are cautious to not build more than 1.4 million because the lesson they learned in the 2006, 2008, 9 period, because they built too many homes. And, again, right here, they built too many homes. They built about 2 million homes, but there was not enough household formation. So existing home inventory, as you can see here in 2007, there was 4 million homes available. And right now in 2022, there's 1.25 million homes. You see on the news that from March to September, October, there was a huge uptick in inventory. So you see this where it jumps up to 1.25 million. We have a ton of inventory coming on the market, and it's really driving a lot of fear when we hear that kind of stuff. But if we look at a 10-year history, you could see that there is an upward trend, a downward trend in every year. Because what that is that, people want to be people who have children want to be in their home before school starts. So, they want to move in their home June, July, August, and be settled into their new home so that when school starts, their kids can be in school and not have to start school in the middle of the year. So in that case, they would have to have sold their home, put their house on the market April, May, June, July. And so this is what we're seeing is April, May, June, July, and then it goes down. So when people are saying that we're getting an uptrend in inventory, that's normal when you're looking at it in an expanded form of 10 years versus just, what's happened this year. So be careful what you listen to on the media. One other thing is that the 1.25 million active homes also includes homes that are under contract, which means they're pending. They have a buyer. So 41% of that number is actually pending homes. So in reality, in September of 2022, you're looking at 732 homes available, not 1.25. And if you take a look at this graph, we're actually lower than the normal. So the normal is 25% under contract, whereas right now we're at 41%. So we are selling more homes. More homes are pending right now than they are on a normal market. Another thing that I want to talk about is foreclosures. This is what we're seeing on the news right now. And I see so many people coming into my open houses saying there's going to be a foreclosure wave. Foreclosures are up more than 150%. And, I really want to cover this topic because there's a lot of data behind this. So during the pandemic last year and the year before, there was a foreclosure moratorium. You could not foreclose on a home. So obviously, when that moratorium ends, foreclosures are going to happen. So that's why there is a really big percentage of year over year from 2021 to right now, or July, that there's 150%. It's true. This is true statistics. But that's because there was no foreclosures happening in 2021. Now, if you take a look at January to January foreclosure activity each year, in 2022, we have 164,581 foreclosures. Yes, it is up from 2021 because of the moratorium. But if you take a look at pre-pandemic times, even in 2020, we're equal to 2020, and then we're also a lot lower than 2019, 2018. And then if you look at 2008 and 2009 and 2010, I mean, look at the difference of the amount of foreclosures that we have. Also, a lot of the people who own homes right now have a lot of equity. The average homeowner has 58% equity in their home. So just be careful with, people telling you to wait for foreclosures, because there's a lot of data available. It's just they don't really share this information with you on the news. So yes, housing prices have gone up quite a bit. And the other concern we have is affordability. So in 2021, let's say a $400,000 home sold for 3.5, your mortgage payment is $1,796. The average household income, according to Fannie Mae, who was able to buy a $400,000 home, is $9,000. So in order to buy a $400,000 home, you have a 3.5% rate, $1,796 mortgage payments. You have to have monthly $9,000. So going into 2022, where we had 15% appreciation, that $400,000 home is now $460,000, but our interest rate is at 7%. So your $1,800 payment is now $3,000 a month. That is $1,264 more than this payment right here. So according to ADP, year over year, people who stayed at their job got a pay increase of 7.8%. And then people who switched jobs got a pay increase of 15.7%. So because there were more stayers than switchers, they averaged 9%. So this number right here, if you had a 9% increase in pay, you would have $9,800 household income, which would offset this payment. You would be paying $810 more than this scenario right here. But because of inflation, you have gas prices go up, food, services, etc. So your monthly expenses are going up due to inflation. Well, let's say for 2023, let's say you stayed at your job and you had a 7.8% increase in pay. That brings you to $10,575 as your household income for 2023. So then this would offset, the inflation cost right here. This is the net worth tier. So net worth is all your assets minus your liabilities. And to be in the top 1%, you're looking at $10.8 million of net worth. Top 2%, you're looking at $2.5 million. Top 5%, you're looking at $1 million. Top 10%, $800,000. Top 50%, you're looking at $500,000. And on average, 2/3 of the net worth from these are from home equity. So think about that. So you're either building your net worth or you're building your landlord's net worth. So let's talk about buying versus renting. So let's say you bought a home for $400,000, you put 10% down, and your interest rate's at 7.5%. So you are expected to be in your home for 9 years. You have, these are the things that you have to think about in the long term: annual property taxes increase by 2%, monthly repair costs, and cost to sell your home is 6% of the appreciated value, which goes to like realtor commissions and closing costs, whatnot. A 63-year historical average appreciation is 4.49%. Right now, we're averaging probably about 5.5%, but with some downturns and stuff like that, over the 63-year history, it's 4.49. So if you're taking a look at this, to rent, it's probably going to be about $2,800 a month. But if you were to buy, you're looking at almost $3,500 a month. So as someone looking at this in the beginning, I am going to say, yes, it's definitely cheaper to rent a home. But because rents increase, they actually say rents increase 8% a year. But right here in this numbers, we're using 6%. So we have a 7.5% interest rate with 6% annual rental increase. So you are paying more in mortgage year 1, 2, 3. Then you start taking up on 4. About year 5, you're break even with rent and your mortgage. And then 6, 7, 8, and 9 years, you're actually paying more in rent than you would be paying your mortgage. Another thing that people don't take into consideration is that when you're paying your mortgage, your monthly P&I, which is principal and interest, so the interest that you're paying on your mortgage payment, this $2,500 right here, the interest portion does go back to the bank, but the rest of that money goes towards your equity. So, that is still the buyer, or the buyer, the new owner's money. So over the 9 years that you're paying your mortgage, the amortization gain you're getting is $41,000. This is just by you paying your mortgage for 9 years. You're paying down your balance. So your original balance would be $360,000, and after 9 years, your principal balance is $318,966. Now, because we are forecasting a 4.49% appreciation, and you estimate the value after 9 years, you're looking at $193,926 in appreciation over the 9 years. So think about that. So yes, you'll probably be negative in the first 2 years, but over the long run, 9 years, you would have gained $205,000 by buying a home. And this is after taking out closing costs, cost to sell, all that stuff. So why wouldn't you invest in your future? I know 7.5% sounds so high right now, but if you take a look at this information and how much value you would gain, it's just, this is how people create wealth. So if you're planning on staying in the home for 2 years, you definitely probably shouldn't buy. But if you're planning to stay in the home for 5, 6, 7, 8, 9 years, it doesn't make sense not to. So again, this is a great opportunity to get into a home. You can negotiate on better prices. You can get seller credits to buy your rate down, either do a permanent rate buy down or a 2-1 buy down. In my opinion, there's a good chance that rates are going to go down due to the numbers that we're seeing with inflation and the history of what's happened in the market. And you can refinance and then also over time build wealth. All right, guys, I hope you found this video helpful. Again, if you have any questions about the information that I provided in this video, other information about certain areas in Northern California, if you're ready to make a move here, make sure again to give us a call, shoot us a text, or send us an email, and we would be happy to help you. And again, if you haven't subscribed to our channel, make sure to give a little love to that subscribe button, and we'll catch you on the next video. Bye.